I picked this topic, of IFRS. Again, it's the same as Chong Wen's, topic. But Chong Wen, was talking more about the higher level, higher level materials or aspects, of the new accounting system. I'm going to try to talk more about the lower level or the technical part, or aspects, of the accounting. My colleague, Pak Heksana, several times, indicated to me, that we should try to help, people, in explaining, how this new accounting system, is different, from the current one. A lot of people still don't understand enough, the difference between this new accounting and the current accounting. So what I'm going to try to do here is to show you or to illustrate to you how we can change, the current accounting format to the new format. What we're seeing here, is actually the same thing, the same animal. We're seeing the same animal, but it's just that the way we're seeing the animal, is changed. Instead of seeing the animal, from the front, we see it, from the other direction. And the current format, of the accounting system, you have premium income and investment income, in the revenue side. And then on the expense side, you have expenses, like acquisition expenses, general expenses. You have claims, the actual claims, the claims you pay to the customers, to the policyholders. And then you have this thing, which is very much, mysterious, for many people, reserve increase. This is the current format we have. Now, in the new format, what we're going to have, explained by Chong Wen, we're not going to have that premium income and investment income anymore, What we're going to have are what Chong Wen called provisions of services, using more the actuarial languages, What we're putting, in the revenues are actually allowances, allowance, for claims, allowance for expense, and some other additional stuffs. But in the expense side, you don't have that reserve increase anymore in the new format. You have just claims and expenses. So what we're going to do with the new accounting system, you compare the allowances or the provision of services, in the revenues, you compare it, with the actual claims. The expense component, the provision of services, on expense, gets compared, with the actual expense. So you see the gap, between allowances and actual, So in that sense, this new accounting system is more diagnostic because with this format, you're positioned, better to know where the problem is, One uniqueness, about insurance accounting, is that a lot of things, about the future, which are assessed, based on assumptions, you involve them, in your current book, That reserving thing, is actually present value of things, going to happen in the future. And the projection is based on using assumptions. So you can imagine, things, you projected, happening in the future, you present value that thing, and then you put this thing, in your book, and you use assumptions there, in your calculation. So this new accounting system is a better tool to do the diagnostics. Why? Because all those assumptions, you use in your reserving, will get tested, with this new format. Those assumptions, will go to the provisions of services, in your revenues. And if the gap between the provisions of services and the actual claims or actual expenses, are big, are large, then your assumptions, are not good enough. So in that sense, this accounting system is more diagnostic. So it's a better tool, to help us, diagnose, problems. But of course, the price we have to pay is is not small, yeah. I mean, so much, actuarial stuffs, get involved, in the derivation. So it's confusing, many people, yeah. But I'm picking, a credit insurance example here because we have 6 companies, in the IFG environment, involved, in this preparation project, for IFRS 17. 4 general insurance companies, have been selling, this credit insurance product since a while ago. So I picked this example, for this illustration work, and I'm going to focus, on the P&L. Yeah. Now, I apologize, if it's a little bit involving, a little bit of algebra there. But, that reserve increase, on the expense side basically is broken down to some elements. And then you take some of those elements, to the revenue side, and then you leave, some, still on the expense side. And then you do rearrangement, and then suddenly you see that provision of services, appearing, on the revenue side. And then you don't see anymore, that premium income and investment income. What you're seeing, are provision of services. And then you get to the new format, So can we move to the next slide? I hope 20 minutes, is going to be enough here. Well, this is just content. Next, please. So for this credit insurance example, we have this simplifying assumption to make it easy. We use this, what we call triple decrement model. So to model credit insurance, you basically have 3 decrements operating there. The first decrement is mortality component. If the debitor, is dead, then the credit is becoming in trouble, yeah. Another decrement is default due to non-death cause. So this is actually the actual, general insurance risk, yeah, not the mortality risk. And then the third one, is the decrement related, to the loan being paid off. So there are these 3 possible decrements occurring, in the evolution, of the credit. It can be that the debitor is dead, or the debitor, is defaulting, due to non-death cause, or maybe the loan paid off, by the debitor. That's the model we're going to use, and we're assuming here that premium payment, is done, at the beginning, of the period, and then claims, expenses, are paid, at the end, of the period. Next, please. Yeah, some notations a little bit here. Reserving, when we do reserving, we can calculate the reserve, using best estimate parameters. We have assumptions, on mortality. We have assumptions on default rate. We have assumptions on the rate of loan being paid off. Yeah. If we use best estimates, the reserve you get, is basically the best estimate reserve. But you can put PATs, you can put provisions for adverse deviations. You can put risk adjustments, on those parameters, and your present value is becoming larger, And that's what they call with risk adjustment reserve, yeah, or liability, future claims liability. So RAB, RAE, denote here, future claims liability at the beginning of the period and at the end of the period, and these are the risk adjustment. Sorry, these are the risk adjustments. Yeah, the without risk adjustment reserves, are denoted, by VB and VE here. VB is the beginning balance, of the best estimate reserve, and VE is the closing balance of the best estimate reserve. And then CB denotes the benefits, of the loan. So if death occurs, the saldo of the loan, credit benefits, is paid, to the bank. That's what we mean by CEB here. Next slide, please. And then PB is the benefits, we pay to the bank if the loan gets paid off, Usually the insurance company has to pay back, some of the premium if the deal is canceled, if the loan is paid off, by the debitor, That's in life insurance, that's usually called the cash value, of the insurance. And then QD, QN, QP here, denotes the probability of death, probability of non-death problem, in the loan, defaulting. And QP is the probability that the loan is being paid off. And then I denotes the reserving interest rate, use for the best estimate reserving. P is the premium income. AEA is the without risk adjustment attributable expense allowance. Now, this is assumption, of course, used by the actuary. With these elements, let's go to the next slide. It can be shown, that reserve increase, of the portfolio can be expressed, like this. Okay? You remember, that reserve increase component, in your expense, you have the premium income and investment income, in the revenue side. On the expense side, you have expense, claims, and reserve increase. Now, if you look at the whole portfolio, your reserve increase, can be expressed mathematically, as this one. Summation, of all those premiums, you're dealing with many debitors there, but the mathematics, is like this, with that simplifying assumptions, of course. We have to make it, as simple as possible. Now, let's go to the next slide. If we use words, instead of mathematical expressions, we can use these wordings, if we like. Our reserve increase is actually a total of premium incomes minus total of without risk adjustment attributable expense allowances plus total of without risk adjustment reserve and interest, blah, 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 etc. Now, let's get to the next slide. Let's see the current format, profit and loss statement. You see here, on the revenue side, you have a total premium incomes. You have the investment incomes now. In this case, we break down, the investment income, to two parts. Investment income, associated, with assets backing up the equity, incurred claims liability, and also the risk adjustment part, of the future claims liability. And then the other part, of the investment income is the one, associated, without risk adjustment future claims liability. On the expense, we have attributable expenses, we have the non-attributable expenses, we have the actual death claims, we have the actual non-death problem claims, we have the claims, associated, with loan being paid off, and then we have the change in incurred liability, incurred claims liability, the IBNR, incurred but not reported, and change in without risk adjustment future claims liability. In bahasa Indonesia, we call the incurred claims liability itu cadangan claim. Kalau with risk adjustment future claims liability itu cadangan premi. Nah ini seninya, ini cadangan preminya kita tweak di sini. Jadi change and without risk adjustment future claims liability, we got the expression already, in the previous slide. So now let's put that expression, in this format. Next slide, please. So I'm just putting, those expressions, to this same, current format profit and loss statement. But now I'm going to take the blue one, the blue components, to the left. Also what's the name of that? That's purple, We have blue, red, and purple. I'm going to take the blue and purple components, to the left, to the revenue side. If I take them to the left, to the revenue, I have to change the signs. If it's plus, it's becoming negative, in revenue. If it's negative in the expense, in the revenue, it has to be changed to positive. Because positive thing in the expense, if you put it, in the revenue, it's becoming negative. Yeah? So let's take the blue components and the purple components, to the revenue side. So let's get to the next slide. So we still have the red one, staying, in the expense side. But look at the first line there. You still have, that total of premium incomes. But you have also total premium incomes, with blue color coming from the expense. And one is plus and one is negative, so they get canceled out, right? The premium income get canceled out. So you're left only with the blue, the remaining, blue components and the purple components. And then let's go further, This is the rearrangement, part, of the process. Let's get to the next slide. And then we're combining, some of those elements, put two things, in the bracket. So, for example, the total of without risk adjustment death cost, gets combined, with the total of without risk adjustment reserves release, on death. We combine the two together, make it, one element only instead of two elements. That's actually the one becoming the expected death loss, later, which will get compared, with the actual death claims. So we see the next slide here. You have the expected total of attributable expenses. You have the expected total of death claims. You have expected total of non-death problem claims, and also expected total of loan paid off claims. And the purple one, if you go back to the previous slide, the purple ones, can we go back to the previous slide? Yeah. We combine those two elements, yeah? This element is actually the PET release, the risk adjustment being released, in that period. You have the total of risk adjustments of the policies at the beginning of the period, and then you minus total of the risk adjustment of all the surviving policies not claiming, in the period. So basically you have the risk adjustment release, in that period. So let's go back to the next slide. So you see, you have all those provisions of services, suddenly, appearing, on the revenue side. You don't see anymore, that premium income. You don't see anymore, that investment income. Well, you still have that investment income, at the bottom, yeah. But you have the risk adjustment release, in that period, PET release or risk adjustment release. Let's get to the next slide. This is already the IFRS 17 format then. Yeah. In IFRS 17, you break down, the revenue and the expense, into two parts, and actually three parts, yeah. The insurance service component, and then the investment and finance component, and let's call the third one others, yeah. We put the expected total of attributable expenses, all those provisions, of services, in the insurance, service. Also the risk adjustment release. And then the investment income gets put, in the investment and finance, component, of the book, of the P&L. Now we still have none, on the others, on the revenue side, but we're going to have some, later, when we consider new business, Okay, so you can see this type of format is more diagnostic because we can compare the expected losses, expected death claims, with the actual death claims. The gap, can be positive or negative. If it's positive, it's gain. If it's negative, it's loss. If you see big losses, you know that your assumptions, are needing, to be reviewed. Yeah, you do basis review, say once every year. All those assumptions, have to be adjusted. Have to be reviewed. From time to time. We're trying to model the future, using assumptions, in insurance accounting, and then you put it, in your book. So from time to time, those assumptions have to be reviewed. If your gap, is big, then that those assumptions have to be checked. You have to revise them, from time to time. Time is actually up, and I haven't got the chance, to show the new business part. Can we go it quickly? Yeah. Next slide, just quickly. So on new business, I'm sorry that it's a little bit, algebraic here. The reserve increase, is expressed, by VE plus RAE minus 0. Why? Because beginning balance of your liability when you injected new business, at that time, your liability balance, is 0. Yeah. So your reserve increase, in that period, is not VE plus RAE minus VB minus RAB, but it's VE plus RAE minus VB plus RAB plus VB plus RAB. So that the one, colored, looks like orange, yeah? The one in orange, is the thing, we're going to call CSM or loss component, depending on whether it's positive or negative. If the VB plus RAB is negative, then the negative of the VB plus RAB is going to be called contractual surface margin. It's a good sign. The business is good, it's profitable. But if the VB plus RAB is positive, not a good news, yeah? VB plus RAB is going to be called loss component, and you will see that these two components, will go to your book, yeah? So let's get to the next slide, just quickly. This is the expression, with that loss components and CSM. Next slide. Same thing, yeah, but you're adding, total of CSM and total of loss components. Continue. Ya, terus. Nah, sekarang the total of CSMs and the negative of loss components get put, in the revenue side. Now, this is without amortizing the CSM. PSAK 74 requires the CSM to be amortized. But the loss component, no. Loss component will go fully, straight to the revenue. The loss component will go there directly, not being amortized. But PSAK 74 requires CSM to be amortized. Yeah. Under the current accounting system, CSM will flow directly, to your book. But this new requirement, is different. Yeah? You have to amortize that thing. Continue. Yeah, terus. Now here we're putting the loss components, on the other side, of the revenue, but keep the CSM, in the revenue side. Now this is still, without amortization of the CSM. So get to the next slide. If you amortize, berikutnya Pak. If you amortize the CSM, lanjut ya, ini masih PSAK 74-nya tanpa amortisasi CSM. Terus? Ya, ini requirement bahwa itu harus diamortisasi. Lanjut. Jadi, in the first period, you have the amortization, the first amortization of the CSM, getting to your revenue. And then the total of loss components, getting to the other part, of your revenue. Yeah, this is first period. Let's get to the next period. So next slide, please. You see, on the other period, you're still having, amortization of the CSM, but the LC is not there anymore because LC gets released fully, in your first period only. Yeah, jadi LC, loss component, kerugian itu langsung masuk ke buku secara full ya. Kalau keuntungan CSM itu harus diamortisasi. Ini ciri khas dari PSAK ini. Jadi saya kira mungkin dari saya itu aja. This is we're trying to show, how, the current format, can be changed, to the new format. So we're actually seeing the same thing, but we're just seeing it differently. makes it better. We can do diagnostics, more easily. But the price, is not small. Yeah, we have to do so many things, to prepare ourselves, for this thing.